Welcome to DWS Market Update. Although inflation rates are falling worldwide, they are still far too high, and core rates in particular are showing a varying persistence. Central banks are fighting high inflation rates with bold interest rate hikes that many market observers would not have believed them capable of in the past. The Fed has raised key rates by more than 5 percentage points in a year and a half, and even the ECB, which is considered somewhat hesitant, has raised key rates by 4 percentage points. One or two more interest rate hikes, but that should be it. That's how markets see it. But assume that upcoming inflation data would make it necessary to raise interest rates even further or to keep them at the elevated level for much longer than previously anticipated. Would central banks be able to keep it up? Many point out that governments are so highly indebted that central banks cannot raise interest rates as much as they should because governments would collapse under the interest burden. This discussion goes under the heading of fiscal dominance. What's the truth of that? We thought that central banks are really constrained in their inflation-fighting activities by governments. For one thing, interest rates 10 years ago were about the same as they are today. So, if a government bond issued 10 years ago is replaced by a new one today, the government will not be paying higher interest than before. Moreover, the low interest rates of recent years have meant that in the euro area, for example, the interest rate burden on governments, in relation to GDP, will be significantly lower for the foreseeable future than it was 5 or 10 years ago. In addition, given the high level of macroeconomic debt, interest rates do not even need to be raised to the levels of the 80s or 90s to have the same macroeconomic effect. However, governments and also many households and companies have taken advantage of the low interest rates to agree on longer maturities. So it takes longer for the increased interest rates to have their full effect. This is also one of the reasons why we expect interest rates to remain high for longer. In any case, central banks should be able to do what is necessary to contain inflation. No one should hope for too rapid interest rate cuts from the Fed or the ECB. With that, I say goodbye until next time.